Financial daddy and investment life bring you freedom of financial.
What's up everybody, welcome back to the channel. Today is November 18th, 2025 and the market is getting smoked again. Nasdaq closed down another 1.2%, S&P off 0.8%, Bitcoin dipped below 91k at one point. People in the comments are freaking out. Is this the big one? AI bubble popping? Are we going back to 2022 bear market lows? Relax, grab a coffee, let's look at the actual data together. From the October highs, Nasdaq is already down roughly 12%, S&P down 10%, Bitcoin's off more than 26%, that's real pain, no question, but 10 to 15% pullbacks happen all the time in bull markets. The real question is, are we rolling over into a new bear market, or is this just a healthy correction? I use three main indicators to call bottoms. Let's run through them real quick. Number one, Bitcoin. The ultimate risk on asset, Bitcoin got crushed from 126k down to the low 89 to 90k zone. That's a 28% drop, technically already in a bear market for crypto, but the last 48 hours we've seen a massive bounce with huge volume. If BTC can hold above 90k, that's usually a leading signal that risk money is coming back in. So far, so good. Two, VIX, the fear gauge. Right now the VIX is sitting at about 23.4. Yeah, it's up from the 15-18 range we had last month, but 23 is not panic territory. 2022 bear market, VIX hit 36. 2020 COVID crash, 82. 2008, over 80. 23 just means the market's nervous, not having a heart attack. There are three. 10-year Treasury yields are hanging around 4.1, 4.4%. In a true meltdown, money floods into treasuries and yields collapse. That's not happening. In fact, the odds of a December rate cut have actually dropped to around 50-55% on CME FedWatch, meaning the bond market isn't pricing in emergency cuts. That keeps a lid on the everything is doomed narrative. Put it all together, we've got real pressure no doubt, slower rate cuts, fiscal worries, profit taking after a monster run, but we are not seeing the hallmarks of a major crash yet. My base case is still a total drawdown of 15-20% from the highs. We're already 60-70% of the way there. A little more volatility is possible, but the worst is likely behind us. AI bubble bursting tomorrow? Nah. Valuations are stretched, capital spending is wild, but cash flows are still insane and most of those convertible bonds don't mature until 2029 to 2031. Worst case, we get slower growth, not implosions. So, do we start buying yet? If you're sitting on a lot of cash, I'd say start nibbling. Definitely not all in yet, but you can begin layering in on weakness. Wait for a couple more confirmation signals, BTC holding 90k, VIX dropping back under 20 if you want to be extra safe. If I had to pick one stock right now in the China tech space, it's still Alibaba, BABA, 99988. Here's why it's my top conviction name: insanely cheap valuation, forward PE around 14-15x. Microsoft is 36x, Tencent 27x, Amazon 35x. Alibaba is by far the cheapest big tech name out there. Their AI game is legit and accelerating. The Tongyi Tianwen Quen app just went live globally on the Apple App Store and Google Play a few days ago. This isn't just enterprise stuff anymore. They're pushing hard into consumer and developer ecosystems. Latest Quen models are beating GPT-4o on several public benchmarks. Dominant position in China's AI infrastructure. Pretty much every major Chinese AI player, DeepSeek, Moonshot, even a lot of government projects, ends up training and deploying on Alibaba Cloud. They're basically the AWS of China with way less competition. Massive buyback machine. They've already repurchased over $12 billion this fiscal year and have tons of firepower left. That's 4 to 6% of the float disappearing every year. Basically free upside. Rock solid cash flow and dividend free cash flow yield 8 to 9%. Even if AI slows down tomorrow, the core e-commerce plus cloud business alone justifies a much higher valuation. Price targets: Hong Kong shares 9988. Conservative: HK 110, 130, 20, 40% upside. Bull case: HK 150, 180. Longer term, biggest risks: obviously geopolitics and the pace of China's economic recovery. Quick recap. This correction isn't over yet, but it doesn't look like the start of a new bear market. No need to panic. Start thinking about deploying cash on weakness. Alibaba remains the single best risk-reward setup in big cap China tech right now. What do you guys think? Is this dip a buying opportunity or are we going lower? Are you holding BABA or waiting on the sidelines? Drop your thoughts in the comments. Smash the like button if this helped. Subscribe and hit the bell so you don't miss tomorrow's update. Catch you in the next one. Stay calm and keep stacking. Peace.
Please subscribe and follow New York Daddy Investment.